Greetings and welcome to episode number 3 of my podcast, Cash Talk with Scott, where I impart information, advice, and guidance on all topics dealing with your financial wellness. I want to start off today's podcast with a situation. So close your eyes and open your mind and imagine, if you will, you're driving to work. You get to work, you park, you take a quick look at your phone before you head in. You pop open your brokerage account, check the balance, $100,000 jackpot. Can't believe it. What a number. You close up your phone, head into the office real quick. You have a very busy morning filled with calls and meetings. Your first break's at lunch. You sit down, got your sandwich, you pull out your phone to catch up on the morning's events, and you open your phone to find it's blowing up with alerts. Crypto this is down, crypto that is down, crypto way down. You're scratching your head and, oh my goodness, what is this all about? You're thinking, because 2 years ago, around the water cooler, you heard all about this crypto. You did a bunch of due diligence, at least 20 minutes on the internet, and you invested all of your personal money into crypto. And over the last 2 years, it's been nothing but awesome. Goes up and up and up. Who knows why, but it just keeps on setting records every week and month. It's been awesome. But today, these alerts, crypto dropping, you're thinking to yourself, I wonder what the impact on all these alerts have on my crypto account. So you whip out the phone, open it up. WTF, my brokerage account balance is $60,000. It was 100K this morning. It's dropped 40,000 in a morning. I can't, I, what do you do? Well, unfortunately, in the world of investments, there are not many do-overs, and this is not a do-over situation. Once your account is dropped in value, it's dropped in value. Here, the best measure is prevention. You need to prevent this from happening. And by the way, this little fictional situation we just ran through, it's not really that fictional. Crypto has dropped over 50% in the last few months. Didn't happen in one morning, but it happened very quickly. So your defense against this sort of day, this sort of event, is diversification and asset allocation. Diversification meaning spreading your investment dollars out amongst different investment types. You'll recall at the end of my podcast on stocks and bonds, I talked about investing in more than one stock, more than one type of stock. Same with bonds, more than one bond, more than one type of bond. I would take that diversification even further and spread it out amongst different investment types. The whole purpose behind diversification is to reduce the risk in the investment portfolio. Diversification and asset allocation reduce the risk. They smooth out the ride. Mathematically, diversification reduces long-term risk in your portfolio, and it does not sacrifice performance. Now, one point here, when we talk about risk with regard to investments, risk in the investment world, it's not like other areas. We're not talking about the risk of losing your money. Your money's gone. Oh my gosh, where's my money go? Risk in the world of investments is actually a mathematical data point. It's the measurement between the high and the low performance of an investment. So the risk is the delta, the difference between the high and the low performance. So something that's not risky, like a money market, because it doesn't ever go down, only goes up a tiny, tiny bit, that's low risk. Stocks, on the other hand, can go way up and way down in a very short period of time. That's a lot of risk. Actually, the data point that measures risk is called standard deviation. Your portfolio should never contain more risk than you're comfortable with. You can never have your portfolio dropping to the extent that it makes you very upset. Can't sleep, chasing the dog around, not very pleasant. Can't have that. You must be comfortable with your portfolio at all times, good and bad. So you must be aware of the risk in your portfolio. There are very few things that we can control and manage in the world of investments. Performance, not at all. The performance is what it's going to be. We can manage and control risk because we can measure the up and down performance of an investment. So we can manage risk. We can make sure that the risk in a portfolio is not greater than the tolerance for risk that the investor has. Another important purpose for diversification: different areas of the market are going to react differently to the same events. Additionally, one area of the market can trigger a reaction in another area of the market. We in the investment world tend to have what we call seesaw effects, where when something goes up, it tends to cause something else to go down, and the reverse, something goes down, it causes something else to go up. The traditional age-old seesaw is with stocks and bonds. So if, for example, stocks are having a bad day, well, stock investors are going to get nervous about that. They might want to reduce their exposure to stocks. They might want to sell some of their stocks. And with that money, they need to take it and put it into something else. Well, even if they put it into a money market, those are bonds. Or they decide to be conservative with that money. They sold their stocks because they sold their stocks with it. They want to be conservative, so they invest in bonds. Well, stocks are dropping. People take their money out of stocks. They put it into bonds. That causes demand in bonds and causes bonds to go up. So stocks go down, bonds go up. Conversely, stocks have a good day. Well, people are going to want to get in on that and buy more stocks. So they're going to take their money out of the bonds, out of the conservative stuff, liquidate that, take that cash and invest it into stocks. So that'll further cause stocks to go up with more demand and the bonds to go down with the decrease in demand. So seesaw effect. We never know which end of the seesaw is going up and going down, so we just cover both ends of the seesaw. That's how diversification works. You want to spread out your risk. You do not want to have all of your investment account act in sync with one specific type of investment option. I mean, it's great when it goes up, but the crypto bad day, nobody can handle that. So we want our investments to be moving not in sync with one specific investment option. That the investment term is called negative correlation. If an investment correlates to something, that means it behaves exactly like that. It imitates it exactly. If an investment has negative correlation, that means it's going to move in the opposite direction. So in your portfolio, you want investments that all have negative correlation to one another. So they all move in different directions at different times for different reasons. That's great diversification. So how do you diversify and achieve asset allocation without going and getting another college degree or spending the entire weekend glued to the computer? Actually, very simple. There are two investment vehicles that'll give you diversification and asset allocation, and they're in your 401k plan. There are mutual funds and ETFs. ETF, by the way, stands for exchange traded funds. Mutual funds have been around for a very long time. ETFs are rather new to the scene. Think of both as being a bucket that's filled with stocks and or bonds. They will have as few as 100 stocks or bonds all the way up to 5,000 stocks or bonds. There's funds that cover every type of stock or bond in very small areas of the market, all the way up to funds that cover every single investment that's available in the market, and then everything in between. There are 5,500 or so stocks here in the United States, and there are over 7,000 unique mutual funds and ETFs. So there's a lot of overlap. As an investor, you need to be sure you understand what the fund's investing in. So you're not investing in 3 funds that invest in the same type of investments. In the 401k plans that I manage, I make sure when I display the fund list, I show each fund in its appropriate category. And we only ever have 1 or 2 funds in each category. So you want to be sure you understand what type of fund it is, what it's investing in. Mutual funds and ETFs provide diversification, but investors might need to take diversification a step further and invest in more than one mutual fund. Mutual funds and ETFs make life easy because they buy and sell all the investments. Investors don't have to do it. They just invest their money in the fund. The fund buys and sells the investments. ETFs Some of them use very sophisticated algorithms to buy and sell investments within the fund. So they're using algos every day to make investment decisions. With the mutual fund, most of them have no minimum buy-in, so you can invest as little as a few dollars and invest as a little as few dollars on an ongoing basis. Some do have minimums, but most don't. ETFs act more like a stock. You must purchase an entire share of the ETF. So if one share of an ETF is $500, you got to have $500 to buy that one share, and then you need to have $500 to buy ongoing shares. So ETFs and mutual funds are a little bit different in that respect. Also, mutual funds are valued at the end of every market day. So the market closes, all of the investments in the fund are valued, and they come up with the value for the fund at the end of every day. ETFs, again, act more like a stock. The ETF's going to change in value throughout the market day as the underlying investments change in value. Mutual funds and ETFs buy the stocks or bonds for the investor. Now, there are two basic management styles used. The first is active management, the second, passive management. With active management, you have human beings who are using research, analysis, due diligence, trying to identify stocks and or bonds that stand out, that beat the market, that do better than the market. With passive management, you are investing in the market, not in investments which have been identified to try to beat the market, but you're investing in the market as a whole. So with passive management, they use indexes. Now, indexes are baskets of stock created primarily in the first place as a benchmark, something that's used to compare and measure investments. So if you, for example, are operating an investment and you earn 10% in a given year, well, 10% rate of return for 1 year is fantastic. But you think to yourself, what about my competition? What did other similar investments return? Did they do 10? Less? More, perhaps? That's where the benchmark comes in, because the benchmark is that basket of stocks. And so you use that benchmark, it provides you the performance for all of those stocks in that basket. So then anybody who's managing within that area has something they can compare to. Over the years, they turned these indexes into actual investment funds. So you could not only use them as a benchmark, but now you can invest your money into them. And so now you're investing your dollars into that specific basket of stocks. And there's basically a basket of stocks for every type of stock, same for bonds. There's many, many, many types of indexes out there. Indexes are set up by investment companies. There's a handful of companies who set up and manage indexes. So they determine the basket of stocks, and then they develop a computer program that operates to make sure that the index fund is always buying the stocks in the basket and investing in the correct proportions to the specific stocks. So the computer program is basically operating and running the fund based on the parameters set by the investment company. Then the investment company sells subscriptions to their index. So if you're a mutual fund or ETF and you want to offer a specific index in your fund lineup, you just go and get the subscription for that index from the company that develops and manages the computer program. And that's the way you want to do it. You don't want to try to replicate that yourself. Just go and buy the subscription for the actual index. It's the lowest cost, most prudent way to go. So on a cost basis, index funds, these passively managed funds, have much lower cost than actively managed funds. So the index funds paying a subscription fee is so much lower cost than with the actively managed funds, paying human beings and sending them all over to travel and visit companies and go through their books, and all of that research and analysis has additional costs. So passively managed index funds have lower costs than actively managed funds. The most popular index fund, and most popular by a long shot, is the S&P 500. So S&P stands for Standard and Poor's, because Standard and Poor's is the company that developed this particular basket of stocks. The 500 refers to the fact that this index holds 500 of the largest company stocks here in the US. It's the most popular index because it covers the greatest amount of the investable market, and it contains all of the companies everybody knows, loves, and can't live without. You may recall where I mentioned in the stock podcast that large company stocks, you have mid company and small company. Large company stocks make up about 80% of all stocks. Mid cap or medium sized, 15%, small cap, 5%. So the bulk of investments are large cap. The S&P 500 is a large cap index. So it is a benchmark that's used by lots and lots and lots of investments. And I'm going to let you in on a little secret. The S&P 500 beats about 70% of the investments that use it as a benchmark. So not only is it very popular, it has terrific performance. All right, so I mentioned some investors might want more diversification than one single fund, ETF, or mutual fund provides. How do you go about doing that? Again, without spending your entire weekend glued to the computer, another very simple answer. Most 401k plans have or what are called target date funds or retirement funds. They're put together and managed for you, for the investor, by the investment company. Investment company picks all the investments, buys low, sells high, manages the mix on an ongoing basis. It is truly the autopilot approach. They're age-based because younger investors should be more growth-oriented, and investors who are close to and into retirement should be conservative. In the target date funds, the managers handle that. There is what's called the glide path. That's basically the level of risk in the portfolios. It remains at the same constant level when the portfolios are for younger people. It stays at that constant growth or risk level for growth until the investor gets close to retirement, about 15 years away. Then the managers of the target date funds change the mix, manipulate the mix, reducing the risk gradually, slowly, so that when the investor gets to their retirement age, the mix is appropriate for a retired person. So the target date funds are the best option for people who want the truly hands-off autopilot approach. Some people want to do the DIY approach to investing, and I love that. I mean, it's not for everybody. Not everybody's interested in it or likes it, but some do. And if you are, please reach out. I'd love to help you, give you more information. If you are going to build your own portfolio, I would obviously suggest that you make the S&P 500 index a cornerstone to your portfolio. I mean, after all, it beat over 70% of its competitors. That's pretty good. Some people have come to me and said, I'm just going to use the S&P 500. My response, I can't argue with that. It's 500 different stocks. That's pretty good diversification. The only issue, and again, the issue I mentioned before, is risk. You can't have a portfolio that has more risk in it than you're comfortable, because that can lead to you committing a mortal sin. That's the mortal sin of panic selling. You're watching your account drop in value. It's 3 a.m. You can't take it anymore. I haven't slept in 4 days. I haven't eaten. I don't remember my kids' names. I am a mess. So I need to get out of these investments. Boom, you trigger that. The problem with timing the market, and it's a significant problem, is you have to be perfect twice. You have to get your money out at the perfect time, and you have to reinvest at the perfect time. Remember watching cartoons on a Saturday morning, the Roadrunner and the Coyote? Remember when the Roadrunner would be in that little shack that would come off the cliff and fall thousands of feet to the canyon below? And the instant before the shack hit the ground, the Roadrunner would jump up in the air and the shack would hit the ground, crumble to bits, and then the Roadrunner would land harmlessly on top of all the debris. Yeah, that's what you have to do when you time the market. And it's harder in real life than it looks in the cartoons. So you got to make sure your portfolio matches your comfort level. Now, on that, I meet with people from time to time who come up to me, and some of them do so in a very kind of discreet manner and say, hey, you know, the target date fund that matches to my age, I'm not really, I don't like it because for a lot of reasons, I want to try to make more money in my 401k or in my investment account. I want to take on more risk than would these target date funds peg me for at my age. A lot of reasons. People might feel like they're behind. They want to try to add some spice, some sriracha to their investment mix, try to spice up the risk to increase their potential for return. There's a lot of reasons for that. And as long as you're comfortable with the additional risk, that's fine to do. That's fine to take on more risk in your portfolio. Give me a call. I can help you do that. A lot of people think that if they take the target date fund that's, say, 10 years younger than them, that'll increase their risk. Actually, it won't. All of the target date funds for young people are exactly the same. What's different about them is the point in time in the future when the managers will start reducing risk. So if you're in the 2030 fund and you think, well, I'll just go to the 2050 fund, that is not going to be more aggressive today. That's going to be something that'll be more aggressive in the future. So give me a call. I can help you add some sriracha to your investment mix, because last thing with that, from time to time, and we're just about getting into it, one of the basic descriptions for the stock market is risk on or risk off. Risk on, that means that all signals, all indicators are green. Nobody knows for certain what the future holds, but the indicators seem to say that all things look good for the stock market. In that sort of environment, why not take a little bit more risk? Because things look like it's going to pay off. A risk off environment's the opposite. Yeah, very tenuous. Doesn't look very good for stocks. We're expecting some bad news here anytime soon. The stock market could correct at any time. That's a risk off environment. Absolutely not the time to take more risk in your portfolio to buy more stock. That's the time to stay protected. So reach out, give me a call. I can help with your personal asset allocation, helping you to diversify properly. I hope you enjoyed episode number 3 of Cash Talk with Scott. More importantly, I hope you gained information that'll help you to better understand investing. I am here to help you. The purpose of my podcast is to build your financial wellness. I have nothing to sell, just help and advice for free. Please reach out anytime with questions or for help with your personal situation. Also, if there are any financial wellness topics that are of interest to you or issues you or a family member are experiencing, please reach out and let me know. I'll put together an episode specifically for your situation. Please click subscribe below so you'll be alerted when I post new episodes. Thanks, and I look forward to chatting and podcasting with you soon.